Hello and welcome to today's video. People come in various forms: mentality, mindset, attitude, opinion, temperament, and outlook. With nearly 8 billion people ticking the world population clock in 2022, we certainly have a variety. But is there anything common in them? One factor is common for all of us, and that is a fund portfolio will work for all of them. If you're here watching the Seasoned Investor series, I assume you would know what mutual funds and ETFs are. So in this video, we'll not discuss what mutual funds and ETFs are, but we'll try and understand how they are available for every person from any walks of life and how to make them fit for your own use. The best fit for your own use when the market is volatile or even when the market is stable. Each class of people has a unique amount of risk appetite that they can handle. And if you're not one of them that are in the market, you need to move towards investment products and the returns that are right for you. The wide world of mutual funds, index funds, ETFs can provide you with the returns for your dreams and goals. Generally, if we categorize a mutual fund into three types, it would differentiate itself as an aggressive mutual fund, a conservative mutual fund, or a moderate mutual fund. Now, if you have a high risk appetite, you can go for an aggressive mutual fund portfolio and plunge in your money into it and have a long-term vision to generate wealth. We recommend a time frame of at least 10 years or more in such mutual funds, in an aggressive mutual fund. Now, with a 10-year or a more time horizon, with this kind of time horizon in the market, you can go for the extra risk that these mutual funds has to offer to generate the extra returns that they provide you on top of any normal returns that any other investment can give you. But what happens is, over a longer period of time, which is 10 years or more, these fluctuations, these risks, they nullify itself, and in a long run, the returns are much more healthier. With time in your hand, if there is a downturn in the market, you still have time for you to recover your investments. You still get enough time to recover and come back. With time in your hand, you also get to average out your investments and average out the volatility that is there in the market, and you can hope the returns to outpace the inflation by a wide margin. For anyone who has more than 15 years in hand, you have the option to diversify your funds within India and outside India. Or if you're watching this video from any other country, you have the option to invest or diversify within your country and outside your country. We personally feel that this is our personal suggestion. You may or may not go by this, but a 35% allocation into small cap funds, 50% allocation into mid cap or a flexi cap fund, and 15% in large cap or maybe the Sensex index funds would be a good mix. But again, this depends on your risk appetite. But this is a healthy mix for any portfolio. This is just a suggestion. You have the right to choose the mix of your mutual fund as per your risk appetite. If you want, you can make it super aggressive by allocating more than 35% into small cap funds, more than 50% into mid cap, flexi cap funds, and just give almost nothing into large caps. That's again as per your risk appetite. If you're afraid of the stock market, if you do not want to take more risk, you can dilute it. You can put more into large cap funds, more into index funds, put lesser amounts and lesser percentages into small cap and mid caps. So as we know, an aggressive portfolio is best suited for a time frame which is more than 10 years. So it's good that you have an aggressive mix in your portfolio when you're into your 20s or you're into your 30s, or at the max into your 40s. A moderate portfolio. This is best suited for those who have entered into their 50s. This is best suited for these kind of people as they provide a better wealth protection plan, and they invest into much safer assets, large cap companies, and the fluctuation, the volatility would be much lesser than those that are invested into small caps and mid caps. So into your 50s, you're almost nearing your retirement. This is the time where you would want your portfolio to stabilize more than to be in a volatile market. You were into your 20s, 30s, into your 40s. You have accumulated a good amount of wealth for the last 20, 30 years. Now it's time for that wealth to stabilize more, to be on a more stable and safe investment. So when you're into your 50s and beyond your 50s, it's time for you to shift your small cap and mid cap investments into large cap or index funds. You can define your moderate portfolio by allocating approximately around 40 to 50% or maybe 60% into large cap and index funds, and probably the remaining would be into small caps or mid caps. This is a comfort zone for many investors, as this offers good returns without taking unnecessary risks. A conservative portfolio is for those people who do not want to take more risk. They are okay with low returns, but they do not want their core capital to be wiped off. So these people, they seek safer investments. A person nearing his or her retirement should be more conservative. A mix of anything that has got a substantial allocation into safer funds and very minimum into small caps or mid caps constitutes a safe and a conservative portfolio. If you're new in the market and you want to become a seasoned investor, we recommend you to go to a financial advisor and take his help. Take his help even if you fall into one of these three categories. Even if you know your risk appetite, if you understand where you stand, you can be an aggressive investor, you can be a conservative or a moderate investor, whatever it is. Even then, it's advisable to go to a financial advisor and plan out your finances. This can be the best approach because while the investment, they need time to grow. So give that time for the investments to grow. In the meanwhile, you learn what's there in the market, you understand the market, and eventually one day you can replace the financial advisor himself. You can be your own financial advisor. The ETFs, they are like mutual funds, but they are very much different from them. They are traded in the stock market and they have their own ticker symbol. Now, since they are traded in the stock exchange, there are ways you can manage them. Some of them are good in hostile economic conditions, while some of them are really very good when the market is stable. So no matter how the market behaves, once you know these methods, you can tackle them well. Consider the world is in a deep trouble. Situations like the pandemic, war, the political turmoil, the governments switching over, and so on and so forth. There are so many things going on. The economy feels the pressure, and so the exchanges, they also feel the fluctuations at the same time. And these make us unsure of how to proceed. In scenarios like this, there are some possible moves that one can try, and these are limit orders. Setting a limit order sets a price of a ticker as high as you want or as low as you want as per your will, versus the market order, which does not help, hence allowing you to minimize an irrational purchase at an exorbitant price, or to come out at a predefined ticker price, both of which is under your control. Avoid opening and closing trades. During harsh market conditions, generally the opening price and the closing price are way apart, which indicates that the market is in a huge swing. As an investor, you might anticipate what might happen based on what's happening throughout the day, or maybe what has happened overnight. In situations like these, if you choose to take a closing trade, probably you will end up paying too high for the security, or maybe end up collecting too less. So what is the solution to this? As a solution, you might want to wait for maybe an hour or so after the market opens and allow the swing to settle down a bit. At the same time, you would want to settle down and not get involved into the market maybe 1.5 hours before the market close, to avoid the last moment swings coming your way, to allow the end of the day swings to occur without you being involved into the market. The premiums and the discounts. We know what a NAV is, the net asset value, and how these are calculated. So the net asset value is calculated at the end of the day for an asset. They reflect the end of day value for the asset. However, when the security is trading in the market, its current value also fluctuates like any other security that has been traded. This is the indicative NAV value, the INAV, and it provides us the value of the security every 15 seconds. Now, knowing this INAV gives us an indication whether this particular security is trading at a discount or is it trading at a premium. Understanding INAVs can keep your purchases under control. You can avoid purchasing at a premium or maybe selling it off at a discount. Well, this is in short how you can use mutual funds and ETFs to your advantage. However, try and understand the drawbacks and the benefits and the expenses first before you start moving or taking a step towards it. All said and done, all risks accounted for and considered. No matter how smart we are, we should refrain ourselves from leveraging these kind of investments. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.